All right, so in this video, let's just build one of these suckers from scratch. So today is August 17th. It's a Sunday. So the pricing could be off on these, but it's enough. I'll give you all the criteria that I look for. And the pricing, again, the pricing may not be exactly correct because it's the weekend, but you'll see the general idea of what I'm trying to get with these things. So let's go over to, let's just act as if we're going to put one of these trades on. Let's just pretend it's Friday evening, 2 days ago. We're at the end of market with about 30 minutes left in the market is when I try to put these on. The SPX continues trading for 15 minutes after the bell rings. So you could wait until the bell rings and then try to get it on that last 15 minutes. But personally, I always start a little bit early just because I want to make sure I get into the trade. I don't want to be under the gun and like not be able to get the trade on if some weird pricing thing is going on, you know, with like 10 minutes left to go. So I usually start to try to get into these around 12:30 Pacific Coast time. That's 30 minutes before the market closes. But the other thing to keep in mind is that you want to try to get these on as close to where the price is going to be at end of market. So, you know, if there's like, say I try to get this thing on at 12:30 with 30 minutes left, and then within that last 30 minutes, the market makes a tear, makes a big run, that's going to kind of potentially screw up the whole trade. So it's just trying to find a balancing act between giving yourself enough time to actually get the trade on and not getting the position on that's like way out of whack because the market took off on you and you already put your position on. And so that the position isn't ideally positioned. So let's just pretend it's Friday afternoon. So to put these on, what I do is I come over here to the Add Simulated Trades tab. I'll open up the option chain, and this is the 18th, which is tomorrow, Monday. So if it's Friday evening or end of market on Friday, I'm looking to put the Monday 0 DTE trade on, options on. So I just go to the 18th, which is Monday, open this up, then I'll just scroll down here and find, I'll go to At the Money to start with. And this is going to be a bullish trade because we're sort of in a bullish trend right now in the market. So if we're in a bullish trend, I typically want to put bullish trades or trades that favor the bullish side on. If we're in a bearish side, I'd do the opposite. I'd do a bearish trade. But since this is a bullish market we're in, I'm going to go and put a bullish trade on. So that's going to be a call unbalanced condor. So, and I want to get that condor, the outer edge of that condor, as close to the 1 standard deviation line as possible. I want to get as far away from the current money where it's trading at right now. I want to get as far away as I can and build that structure out over here. So I want to get that far into that trade as close as I can to the 1 standard deviation line, and I just know that like the delta, typically the 1 standard deviation line is around, I think it's like a 16 to 20 delta. So to get started, I would just look down this delta column here, scroll down the delta column on the call side. I'm doing a call unbalanced condor. I want a bullish trade. I'll come down to the delta of, let's just start with 19. Well, let's do 16. So I'll come to the 16 delta and I'll just right click here and I'll say analyze by trade. I'll come over here to where it says unbalanced. Then when I put my mouse over the unbalanced, you can see this little window opens up and I'll select condor. So we're analyzed by trade, unbalanced, condor. And it'll just throw that thing, it'll just like pre-populate like a default setup, broken wing or unbalanced condor setup below. Then I need to tweak this into position exactly how I want it. So once that's down there, I'll come up here to the risk profile button, go back to the risk profile screen. And so there's the default unbalanced condor that thinkorswim threw in there. It's a really narrow one. I want this tent to be wider. So what I'm going to do is I'm going to stretch this out. I'm going to just adjust these legs so that we come down here and the far end of this position is around that 1 standard deviation line, which is at 65.10. So I'm just going to adjust this side of it and stretch it out here to get closer to that 1 standard deviation line. So let me just go down by 10 points on this and see where that puts us. So you can see we're closer. Let's do it again. Again, I'm just stretching that outer wing out. So let's stop there for a second. So that's kind of right to that 1 standard deviation line, that dotted line there. And then let's take the other side and pull that side towards where the market's currently trading at. So let's just pull this side up by 10 points and see what that gives us. So there we go. That's getting close. So typically what I'm trying to do is I'm trying to find the correct balance between about 10 to 20 points on this side of where the SPX is currently trading at. So here's the SPX where it's currently trading. I want this side of the condor to be 10 to 20 points to the right of it in this situation with this bullish unbalanced condor. So right now you can see that this is 10, 20. So that's 20 points away. So that fits within my criteria. And if I can get it closer and get a good price for it, that's better. I'll keep stretching either side of these things out, just widening this tent, balanced on either side there. If I can keep this thing with a good price, and a good price for me is like $1 or under. If you can, the cheaper you can get these, the better you're going to be off. And if you're doing the opposite side, like a put broken wing condor, I always find that the pricing is way better. You can get these down to like 40, 50 cents. But when we're doing the call side, the pricing is always a little bit more expensive. So on the call side, I'm hoping to try to get under $1. But right now, the basic idea is to try to get this tent as wide as I can, get it out to as close as I can to the 1 standard deviation line away from the current price, and get this side of it as close as I can to the current price. So let's see how wide this tent is. I'd like to try to get these tents like 30 to 40 points wide if possible. So right now this one is 10, 20, 30, 40. Well, let's go to the inside here. So this is 10, 20, 35. So just from experience, I know that that's probably this is probably the best I'm going to get for under $1. Let's just see. Let's just stretch this wing a little closer to the money by 5 points and see what that does. So that gives us $1.10, which you could go with. That gives you a wider tent and it gets you closer to the money, which is better for you while you're still while your position is still out here to the 1 standard deviation line. But you can see that the wider you make it, the more expensive it's going to be, and the more of a worst case scenario risk you'll have here on this downside here, which if it's $1.10, it's going to be $1.10 potential risk. So I'm going to take these back, and this is just a matter of like kind of playing around with these strikes, trying different things, trying to tweak it in, fine tune it. So I'm going to pull the other side out now a little bit wider, see what that gives us. So that's $1.25. And what this is, I just pulled this side out. So what I would go with is just in the middle there. I want to try to keep it under $1 if I can. So this is 85 cents. And we're very close to that 1 standard deviation dotted line there. And we're 10, 20 points away from at the money. So that's probably the trade that I would go with. So just trying to find that balancing act between getting as close as you can to the current price on this side, as close as you can to 1 standard deviation away on this side, while still with the cheapest you can get, and trying to get at least 30 to 40 points width in this condor here. And again, this is 10, 20, 30. This is 35 points wide. So that's the condor I would go with. Now the other thing you can do is you can tweak these numbers. This is a 1/2, so this is like 1 contract debit spread here, and this is a 2 contract on this side, just longer. We're skipping over that strike. But we could say let's try a 1-to-3 ratio. So instead of 1 debit spread here and 2 here, let's try it and see if we can get a better price if we have 1 here and 3 there. So let's move this up to 3. So that gives us a price of 60, which is better. Of course, it gives us more downside risk. We haven't put the hedge on yet, which we'll do in a second. But without the hedge, you can see the total risk on this now is 1,000. The total risk on this side is 60. Where we had it before with 2, we had a total risk of 85 on this side, and a total risk of 585 on this side. So it's just going to be up to you. This is a way to get the thing cheaper. You're you're giving yourself more risk on this side, but we're still going to have that hedge. So it's just that's going to be trader choice. That's going to be your decision. Typically, well, for this case, I'm just going to go with this one, this first one. A lot of times I'll do this, though. It just really depends on what kind of pricing I can get and how the overall position looks once I get the hedge on. So let's go back to this one. This is going to be a 1x2. So again, this is the broken wing or the unbalanced condor. All this is one debit spread here, one call debit spread here. We're buying and then selling two here that are wider. This debit spread is wider. This is a 10-point wide debit spread or credit spread, I'm sorry. And this is a 5-point wide debit spread. So let's model up the hedge now. So I'll start the hedge off. The hedge is just going to be a debit spread, a call debit spread, starting right here. But depending on what kind of pricing I get, I may move it out a bit. But to start off, I'm going to look at the debit spread that starts with the same long that we have here, which is 65.15. So let's go to the chain, the option chain, 65.15. Come down here, 65.15. I'm going to say buy, analyze buy, vertical. So I'm looking at buying a debit spread. And you can see there's the hedge there. That's one debit spread. You can see the pricing says we can get this for $5. Sometimes I get it. I have gotten it for $5 in the past. Usually, though, I wind up having to pay like 10 cents or 15 cents for these. So even though that says 5, let's just be conservative and say that will actually cost me 10 cents, which is still super cheap. So that's just one debit spread there. So depending on your risk tolerance and what you're comfortable with, you could just put one there, or you could just do nothing if you want. That's what the guy who taught me this trade does. He has no hedge there. He just waits to see if it's actually going to gap up or race up there the next day and then deals with it. But I'm not comfortable with that. I've gotten burned too many times, and I don't want to. It just creates too much stress if it does actually run up there. I mean, you can see that if we were to gap or pop up or run up here real quick tomorrow to, let's just say, 65.20, that would put us at a loss of $260 right at the open, with the potential to lose 585, which isn't cool as far as I'm concerned. I don't want that. So with this hedge, even if we just have one hedge, you can see if it were to jump up there, pop, same thing. If it were to pop up here to 65.20, you can see that we have a loss at that point of $65, which is way better. Plus a capped off risk. We can't lose more than 95. So it's like a fail safe. So you could just do one if you wanted to. Typically what I've been doing lately is doing at least two, which is just because they're so cheap. I mean, 10 cents is nothing for this nice of a hedge. And so this thing, if this thing does gap up or race up, you can see I'm just making money right into that run up. And on the flip side, the downside is it's just costing me $10. So it's just increasing my risk on this side just by 10 measly dollars, which is nothing. If this was like 50 cents or more, 30 cents, it may not be worth it because you're giving yourself more risk, potential risk on this side. But for 10 cents, I'll even take it, as my Uncle Ed used to say. So I either do something like, lately I've either been doing something like this, where I do two of them, and I have the same amount of reward as the actual profit tent here, just with this little gap, which is this little sliver, little pizza pie of risk, which really isn't an issue at all until end of day. If this thing were to move up and just float around in here throughout the day, the first half, like let's say the first 4, 5, 6 hours, there'd be no problem. You'd still be floating up in here. As the day progresses, though, if the price stayed right here and we're into like the last hour of the trading day, like the last 30 minutes to an hour, this could become an issue because eventually this thing will droop, and at the very end of the day this thing will convert and turn into this blue line where you have $500 of risk at the very bottom. Now the probability of that hitting right there is very low, but it is real. I mean, that could happen. But the as far as something like this, I'm not concerned with this throughout the rest of the day. I would wait. If this thing on Monday, I had this trade on and it came up here and it just sat here and did nothing, I would wait until the later part of the day, maybe with like an hour left. And if it was still here, then I may do something. And there's easy ways to get out of this if that's the case. But that's not a problem at all. This is, without any hedge, that's a real issue right from the get-go. I don't want that. But that's not an issue, that risk, until the end of the day. And so if it keeps going up, if it keeps gapping up and raising up higher and higher, you have $395 worth of profit potential all the way up to the moon, as much as you do in this tent. For just $10 more, that's like a no-brainer. And I even sometimes will add another one. I'll just tweak it. If I can get them cheap enough, if I can get them for $5, $10, and maybe 15, depending on what the rest of the structure looks like, I may do something like this where it just really tweaks the thing. So if there was a run up, you can see we're just making money all the way up this pink line because it's being stretched and pulled up by this high cliff here, with the potential to make up to $800 if there was a problem. And that's just going to cost you $10 more of potential risk on the downside. That's a trade-off I think is really worth it. At least as far as I'm concerned, I would take that. Because if we don't need it, there's cool things we can do to eliminate this risk totally and create a huge profit mountain on this side with this. We can get rid of them and bring some more income in if we don't need them. There's a lot of different things we can do. So this is a trade. If I can get this hedge cheap enough, I'd totally do something like this. Just kind of overdo it on the upside. Probably not more than this. That's enough for me. $800 is a nice, super great profit if there was a problem there. Now, sometimes you won't be able to get a hedge on like right at that same long, this cheap. And what I'll do if I can't get that, let's just say that if I wanted to put this hedge on, it costs like say 50 cents. I may want to try a couple strikes out, the same hedge, just move it out by a strike or two to see if I can get that cheaper price of 5, 10, 15 cents. And so in that case, let's just move this out so I can give you an example of what that looks like. So this is 5 points out. I'm just moving the whole debit spread up a little bit to see if I can get a better price if I wasn't able to get that good price at the beginning. So that's 5 points out. Let's see, 10 points out is this. You can still see we have a great slope up. There's no droop into that canyon first thing in the morning. This will be tight. And the higher you can get this side of it, the tighter and the more sloped up this will be. And let's see, let's just go one more. The furthest I've gone is 15 point, with a 15 point gap between this structure and this hedge. And this is 15 points. This is the furthest I've gone, because at some point this thing will start to droop through that. The wider this gets, this will start to droop. So I've gone 15 points like this, and it's still tight enough, because remember, this hedge is really only for it's for the overnight gap problem or the first thing in the morning race up. This isn't the hedge necessarily that you're going to continue to use throughout the rest of the day, because if the SPX opens in this area here, which it most of the times it won't make that gap up, that one standard deviation move up at the open. There's a cool adjustment we can do to immediately eliminate all this risk and just take this off and get way more profit potential on the upside. That's better than this. If there's no issue. This is only like a fail-safe if there's some big gap up overnight. So first thing in the morning, if there's no gap up or no run up, we take this thing off. So 15 points wide is probably as wide as I would go. But if I can get it super tight, like where I had the first one, for cheap enough, for 10 cents, 15 cents, I would do that. If I can't get that one let's go back to where that was. If I can't get it this tight, like using the same long for both, for a cheap price of 5, 10, 15 cents, then I may think about starting to stretch this out, because the further you stretch it out, the cheaper they'll get. At some point, you'll be able to get it for a good, nice cheap price. Okay, so that's the setup for that. So this is the basic setup that I would open up with. And again, the criteria that I'm looking at is I want to get a structure here. Let me take the hedge off for a second. I want to get an unbalanced condor that's 30 to 40 points wide. This is 35 points wide. I want to get the far side of that tent as close as I can to the 1 standard deviation line to give me the safety buffer, the safety zone I need, that I'm comfortable with. And I want to get this side of the tent 20 points or less to the money. The closer I can get to where we're trading at now, the better I'm going to be. But I need to just find the right mix. It's a balancing act between, I want to make sure that I'm out to the 1 standard deviation line and as close as I can get to where we're currently trading at, finding that mix. And hopefully under a buck. If I can get under 50 cents, that's ideal. On these call unbalanced condors, I haven't been able to really, at least recently, find situations where I can get them for 50 cents or less. If I can, that's what I would want. So I'll go like $1. And sometimes I'll even go over $1 if I can't, if I really can't find anything that works. But just keep in mind that you want to keep this as cheap as you can. Under $1 is better, and under 50 cents or less is ideal. So this one's 85 bucks. And again, you can lower that just by increasing the contracts here, tweaking it. And even though if you tweaked it and did a 1x3, brought the price down to 60 on this, you'll just need to increase the number of hedges that you want on this side. So this version here is 1 debit spread to 3, and we just increase that to try to get the cost lower, 60 cents instead of 85 cents. But for our hedge now, just remember that because now we have 3 on this side, we need to potentially increase the number of hedges. The hedges are really cheap though, right? So that's not necessarily a problem. So that's 1 hedge, 2 hedges, 3 hedges, 4 hedges. So we need 4 hedges to get this thing up high above this tent, like we had in the first example, where in that first example we only needed 3. So you're just going to need to increase the hedges on that side if you do a ratio that's more than 1 to 2. So let's go back to 1 to 2. So this is our basic setup that we came up with in this scenario, as close as we can get to the where the SPX is trading, 20 points or less, and as close as we can get to this standard deviation line for under a buck, and then our hedge. And the hedge can be whatever you want. You could have no hedge. I wouldn't advise that. I'm not comfortable with that because at some point you will get burned for sure. You know, maybe 1 out of every 10 trades or something like that, but that at some point you will get burned on that. So by having just 1, you can dramatically decrease the potential to get burned. Your max risk now at this point is 95 bucks, and you've only added $10 of risk on this side in order to get that protection. You can do 2, where now you can just make as much as you can in the profit tent if there was a run up. Or you could do 3 and just kind of overdo it, but get like a lot of profit potential up here in the situation where it may just run up. All right, so that's the basic setup. Now there's a couple things that I do in addition to this to bring up this line here. So you can see right now we have $115 worth of potential loss from here all the way down. Just remember the whole thing with this bow though, this magic bow is going to be working in your favor, so it will be kind of popped up above the line, and it'll continue to move higher and higher and higher into this tent area like I showed you in the first video. But there's ways to reduce this $115 worth of risk, or however much risk is in this. With a couple of cool tweaks, we can bump this thing up, or just create other ways to combat that. And so that is what I will be addressing in the next video. And then after that, we'll look at adjustments, how to adjust this thing here and turn it into like a super rich profit potential trade on the upside. Ways to flatten things out, ways to adjust if it moves this way, and also how to transform and tweak this into what I trade every day, like my look mono hands trades, my levitation trades, my profit bomb trades. This structure overnight trade here can very easily and elegantly morph, simply morph into one of those trades. So it gives you kind of a head start into the trades that I do anyway every day. All right, so that's it for this one. I'll see you in the next one.